Welcome everyone. We've seen an eventful first half of 2023 in the financial markets, with various factors impacting different sectors. The rise in interest rates has been a key driver, leading to a rally in the value of world stocks. It's like a wind that's been pushing the sailboat of the global economy, with stocks riding the waves. Let's turn our attention to the tech sector. The artificial intelligence-inspired tech industry has seen significant gains. The giants of big tech have experienced a surge in their stock prices, making it look like a tech party that everyone wants to join. It's as if these companies have discovered a secret sauce for success. Now, let's journey to Japan. The land of the rising sun has seen its Nikkei share average perform well, shining brightly in the global financial landscape. It's like the cherry blossoms in spring, blooming amidst the global economic landscape. And while we're on the subject of blossoming, let's talk about bonds. Countries that have been financially damaged like El Salvador, Sri Lanka, Zambia, Ukraine, Pakistan, and Argentina have seen positive returns. It's as if these countries have found a silver lining in their economic clouds. The dollar, that age-old stalwart, has remained steady overall. But it's not all rosy in the world of currency. The yen and yuan have depreciated like a balloon slowly losing air. And Turkey's lira has experienced a significant decline. It's as if the lira is on a downhill ski slope and it's picking up speed. While some analysts warn of a potential policy mistake and predict a market downturn and recession in the near future, others believe that inflation and rates may have peaked. It's like standing at a crossroads with two different signposts pointing in opposite directions. Which way will the global economy go? Only time will tell. Now, let's delve into the predictions and forecasts that are creating a buzz in the financial world. There's talk of a potential recession, and as we know, a recession doesn't just happen overnight. It's a result of multiple contributing factors, and right now there are a few warning signs that we cannot ignore. Firstly, inflation is on the rise. Inflation is like that uninvited guest at a party. It's not really welcome, and it can cause a lot of problems. Higher inflation rates mean higher costs for goods and services, and that can put a damper on economic growth. Core inflation in Australia, for instance, rose to 2.6% in the last quarter of 2022, exceeding expectations, and the Reserve Bank of Australia's target band. Next on the radar is the weakening of the Australian and New Zealand dollars. Currencies don't weaken in a vacuum. They're usually a reflection of the broader economic conditions. The weakening of these currencies, despite a positive surprise in domestic inflation, is a sign that investors are turning bearish. This pattern of bearish sentiment against positive domestic economic indicators is worth noting, as it could be a precursor to a downturn. Another significant factor is the impact of geopolitical tensions. These tensions can lead to uncertainty in global financial markets, which often results in investors pulling back from riskier investments. This in turn can lead to a slowdown in economic activity. Lastly, we can't ignore the expected interest rate hikes by the Reserve Bank of Australia and the Reserve Bank of New Zealand. Interest rate hikes are usually implemented to curb inflation, but they can also slow economic growth. While these hikes are happening abroad, they can still have an impact on the global financial markets, including the US. As investors, it's crucial to keep an eye on these signals and prepare for potential market changes. Remember, the best offense is a good defense, and staying informed is the first step towards safeguarding your investments. The performance of global markets inevitably impacts the US economy. Let's see how. The first half of 2023 has been a roller coaster ride for global financial markets, with varied effects on different sectors. This, in turn, has significant implications for the US economy. Let's delve into some key areas. Interest rates play a pivotal role, as central banks around the world have been hiking interest rates, led by the US Federal Reserve. The cost of borrowing increases. This can slow down investment and spending, potentially cooling the economy. On the flip side, higher interest rates can attract international investors to American shores, seeking better returns on their investments. Inflation's impact on the economy is a double-edged sword. On one hand, increased inflation can erode purchasing power, affecting consumer spending, which is a major engine of the US economy. On the other hand, inflation can sometimes be a sign of a healthy economy, indicating increased demand for goods and services. The dollar has remained steady amidst global currency fluctuations. A strong dollar makes foreign goods cheaper for American consumers, potentially boosting spending. However, it can also make American goods more expensive for foreign buyers, potentially hurting American exporters. Rising commodity prices also have a ripple effect on the US economy. For instance, increases in the cost of base metals like zinc and copper can drive up the cost of goods, from electronics to construction materials. This can contribute to inflation and potentially slow economic growth. Finally, let's not forget the impact of the tech sector. The significant gains seen in the big tech giants have a substantial impact on the US economy. These companies not only contribute greatly to the stock market but also play a significant role in job creation and innovation. The US economy is intertwined with global markets, and these factors could have significant implications for investors and consumers alike. With talks of a potential recession in the air, it's essential to know how to prepare. One of the best ways to safeguard your financial health is through diversification. Spreading your investments across different asset classes can help reduce risk and provide a safety net in case of market volatility. This could mean investing in stocks, bonds, commodities, or even real estate. Building an emergency fund is another crucial strategy for recession-proofing your finances. This fund should cover at least 3 to 6 months' worth of living expenses, providing a monetary buffer in case of job loss or other unexpected financial hardships. Remember, it's always better to have a safety net and not need it, than to need it and not have it. Reducing your debt is another key step in preparing for a potential recession. High-interest debt in particular can be a significant burden during tough economic times. By paying down this debt, you can lower your monthly expenses and increase your financial flexibility. Staying informed about market trends is also crucial. Understanding the factors that drive the economy, such as interest rates, inflation, and geopolitical events, can help you make informed decisions about your investments. It's important to remember that while markets may fluctuate, they have historically trended upward over the long term. Lastly, consider seeking advice from a financial professional. They can provide personalized guidance based on your financial goals and risk tolerance. But remember, no one has a crystal ball. Even the most experienced professionals cannot predict market movements with absolute certainty. While it's impossible to predict with certainty, being prepared can help mitigate the impact of a potential recession. Stay informed, stay prepared, and remember, every cloud has a silver lining.